why very well, and I know why I did that. But anyway, and then there's going to be an additional problem on LIFO FIFO, and this comes from I was going through the grading notes for the chapter 4 and 5 exam, and a lot of them were on LIFO FIFO, so I figured I better go over it. And then the new stuff, this is the new. Is the foreign currency transactions. And let's separate that one out so that we know that it's different. All right, so first thing I want to do is go over this chapter 4 textbook problem. It's not really a correction, but it's so it's this one, this handout. And kind of skipped over it for a good reason. It's because I'm a coward. Determine amount which quick company should carry. This is number 4. We didn't fill this one in. Okay, so here are the rules for filling this one in. It is the higher of these two. So the rules are what we recorded at is the higher of or net selling price. Okay, so the higher of discounted cash flows, and underline it. Oops. Or the net selling price. Okay, so let me come up here and talk about the net selling price. Net selling price is whatever you sell it for minus selling costs, like commissions or something like that. So for example, this one might be something like this. Oops, what am I doing? So we have the selling price. Maybe let's pick a number for this one just for yucks. Let's say that it is 55,000. I'll say 54,000. Minus any selling cost. It could be a commission or something like that. I'm just going to make this up so that it comes out to what we want it to. Minus 4,000. And so this will be our net selling price of 50,000. So this is kind of how you come up with a net selling price. Now, if we're talking about finance and the efficient markets, you know it wouldn't make sense that there'd be this kind of a difference, but markets aren't necessarily efficient, so that's why you can come up with them. So let's come down here. So the higher of the discounted cash flows, oops, we don't have to change anything if the answer is correct. Discounted cash flows was 52,000. And that is higher than, where is it? Higher than the net selling price of 50,000. So this is why we go with the 52,000. And the idea is this, if you want to wait around and use this machine for its full life, it's worth 52,000. If you want to sell it today, it's worth 50. And if you're talking about efficient markets, you'd say, okay, well, we want to do whatever higher there. But you also might question, well, how in the world could a selling price be higher than the discounted cash flows? That this is kind of like if these are the best cash flows you can get, these are the value of the machine or whatever it is. And the reason that that could happen is that whatever the asset is, it's being underutilized. If I have a building that I could be renting for $5,000 a month and I'm only renting it for 3,000, it's being underutilized. And so the selling price may very well be much higher than my discounted cash flows because my discounted cash flows are too low. I'm not using it like I should be. So that's how these kind of differences can come about. In efficient markets, they say, oh no, everything's all efficient and you're getting the best cash flows you possibly can, and your utilization of your assets and all this kind of stuff. But in real life, that doesn't necessarily happen. And if a company is not using an asset to its fullest extent, it very well could be that the discounted cash flows are much less than they could actually sell it for. There's other things that come into account too, and that for instance, there's sometimes you need a piece of equipment that you just have to have for the business, whatever it is, that maybe isn't something you make a lot of money on, but you have to have it. And things like hospitals and things like that, they may have some very expensive equipment that, if they don't have it, they can close the doors of the place. But, the fact of the matter is they need to have certain equipment there so that they can do other things. So there's all kinds of reasons why you might have a selling price that's higher. And theoretically, the idea is if you could sell it, why wait around? Let's say that the current day selling price is the 54,000. There's no selling costs. The question would be, why are you going to wait around for 6 more years to make, 52,000 on this thing when you could sell it today for 54,000? Now again, we're in an efficient market, you'd say you'd absolutely sell it for the higher price today. A, there's no risk, and B, that it's higher. So, but that doesn't always happen. So it really could be that they would have those as and whichever one is higher is what you actually put it on the books at. And this is different than, say, sometimes you'd have in the U.S. standards. U.S. standards, other things that are underutilized are put at their net cash flows. So it is a little bit different than the U.S. standards. But the idea is that you could actually sell it, whatever you can sell it for today, versus if you held on to it, what would be the higher of those two, is what theoretically someone would be looking at. Any question on that? Again, the answer is the correct, but it's a lot of discussion, and we're already, I keep doing something stupid here. Yeah. Okay. It keeps showing your guys' faces on the side, and I keep getting rid of it, and it keeps putting them back. I don't know why. Okay, let's go to what are we gonna do next? Oh, the additional LIFO FIFO problem. Let me pull that up. Nope. Yep. Okay, so this is a cut down LIFO FIFO problem. This is one that you see on the test. And the last time I taught this class, there's a lot of notes on this one. So I think that it'd be good to go over it. It's one of those things where you try to make something simpler and it throws people off. What are you doing, man? Um, Actually, before I go on, are there any questions on that first thing we did? Any questions on this thing? No? Okay. Well, let's go to this one. Okay. So we have a foreign subsidiary to U.S. parent company. They sell electric ovens. It has the following cost in U.S. dollars. They sold 260 of these electric ovens in January. And these are the costs. If we're doing first in, first out, which ones are we taking? First.
Beginning inventory.
Yep. Okay, so we need the cost for 300 units. No, we don't. 260. Oops. Okay, and we're going to go first to the beginning inventory. And we can't get all of them, but we can get 200. I'll do the multiplication in a second. We still need the cost for how many? Oops.
60 of them.
Yep. Still need the cost of 60. And there's only one place we can get those, and that is the purchase. Uh, 119. So we'll take 60 of those. $24. And you don't need to put this in, but I'm going to put this in. Need cost for. And at this point, it's 0. We don't need the cost for any of them. We got all 260. So this 260, this is how we got these. Let me zoom in here. So we needed 260. Yep. So let's see. So we need the cost for 260, and let's make it green. So here's how we got it. We got 200 from the beginning, and that's all there was in there. And then there's 60 from. So that's how we got the two costs for this. Okay, so let's multiply these out. And 4,200. I better use Mr. Calculator. Yep. Okay, 4,200. And 60 times 24. $1,444. No, $1,440. I'm sorry. And so this will be the total cost of goods sold. I'm going to move this over. Those two together. What is that? 5640. So this will be our FIFO cost of goods sold. And international standards, FIFO is perfectly fine. In fact, it's probably the way most things do flow is FIFO, first in, first out. And notice if you sold something, say, on January 3rd, it had to have come from this beginning inventory because this inventory wasn't there yet. So this is probably, I shouldn't say probably, it definitely is the most accurate as far as the actual flow of goods. So that's FIFO cost of goods sold. Okay, let's go to the US standards. And let's see, we need the cost for, oh, I'm going to copy that down. See, I'm showing you guys how to be lazy like me. Still need the cost for 260 units, but we're going to use the last ones in, or first out. Now, last in, first out. I think I know I talked about this. I'm going to bore you again with it though. Last ones in, first ones out. These are theoretically the more accurate as far as income is concerned because they have the latest prices. The last one's in, these prices here, let me go up here. This price here is more accurate as far as what the actual value of this inventory is today. And so when we make our income statement, we want to use the most accurate economic value of what we're giving up, and that is the last ones in. Now, this is definitely not how goods flow. Again, notice something that was sold on January 3rd could not have come from something we purchased on January 19th. It wasn't there. But economists, theoretically, the 24 is the better number. And for that reason, a lot of times there's it's shrinking, but it used to be in the 20% to 20 whatever percentage that companies that have it. But now it's probably, I think it's somewhere around, I don't know, 11, 13%. I can't remember. It depends on what you look at as far as companies that actually use it in their financial statements. So anyway, we're gonna say that the last ones in were the first ones sold. Okay, so for last ones in, which inventory do we take it from? The beginning or the purchase?
Purchase.
Purchase. And again, this is theoretically the more accurate number. And we can get all 260 of them from that level. Okay, so we need cost for, so we go to the purchase. Right, yeah. Oh, wait, it should be this. Okay, and we can take all 260 out of this level because there's 300 in that layer. But we can take all of them for this. And I'm going to come down here. You don't need to put this in. But we already got the cost for all of them, so we don't need any more cost. So we just have this one. And so this will be, well, whatever, 260 times it. 6,240. Doesn't look right. Be 200 times 3, 600. It is right. Okay. Like I was saying, that is exactly right. Okay, so this would be our LIFO cost of goods sold. So if we had all the inventory for the US company in LIFO, we would get this, probably off the financial statements and see how they came up with their cost of goods sold. We would recalculate their numbers using LIFO. And then this is what we'd have for our cost of goods sold for the subsidiary. So what would be the difference when comparing US? So the US cost of goods sold would be how much more is it? I think it's 600, right? 6240 minus 5640. I think it's 600. $56.40. So it'd be $600 higher. And usually because of inflation, LIFO has the higher numbers at the end. Not always though. Sometimes you'll have decreases in value and stuff that or in selling prices and that. Okay, what would be the difference in net income when comparing the foreign subsidiary to the US? So our cost of goods for that subsidiary are higher by 20 or by 600. So what's that going to do with the income? I'll give you two choices. It's going to increase the income by 600 or it's going to decrease the income by 600 when they translate it. Which do you think?
Decrease.
Yep, decrease. Income from the would, let's say B, would decrease by 600. The costs are more. Now the subsidiary, they are going to keep their books, using FIFO, and it's, they probably don't care a whole lot what we do. What the parent company does with it once they get it, that's fine with us. But yeah, so the subsidiary, the income for the subsidiary would decrease by 600. So this is an accounting method difference between, and international standards, they don't allow for LIFO. They say nothing flows like that, and there are problems with LIFO. The problems with LIFO are, one of them is you could have inventory that if you never sell it all the way down to the shelves, it's possible that you have this inventory sitting around for hundreds of years, possibly. So you have a very unrealistic inventory on your books for what you currently have on hand. And it may be even a fraction of it. It could be, especially like for instance, I work for U.S. Steel. Steel has been around for a long time. So anyway, if they ever sold down all their steel and they're using LIFO, you could have values in there from the 1950s. Now that steel is long gone from the 1950s, right? I mean, it's not there. It was gone in the 1950s, but the costs are still hanging around because this does not match up to the actual flow of things. So you could actually have, the inventory on the books at 1950s cost, even though the inventory is brand new, the actual cost of the inventory is much more than that. But because you've sold all the last ins for all these years, the beginning inventory was never sold. So there are some wacky things that happen for LIFO, and they can really distort what the what you have on the balance sheet, basically, if you have LIFO. And that's kind of another thing too, difference between the U.S. standards and the international standards. The U.S. standards are nutso about income. They're nutso about it. Everything is income and quarterly income and all that. Whereas international standards, they look more at the long-term picture, and it isn't like how much, what was the increase this quarter from last year? They usually have a much longer time frame, and the balance sheet is more important to them too. What do you have on your books is, as far as assets, is just as important to know what the value of those are as to know exactly what your income is or even the theoretical income. So U.S. standards, they go nutty over the net income. It's really, it's really tight on that. That's what they all look, and the earnings is what they'll tell you. And international companies in general, it's more of a balanced approach. Yeah, they want the income to be accurate, but they also don't want their balance sheet completely messed up so that it's, has nonsense numbers on there from 50, 60 years ago. So anyway, that is, you'll get one of those on the test. Okay. Oh, I know. I know what it is, I think. I think I figured out why I'm messing up here. Okay, let's go ahead and save that one. Yeah, you can turn that one in. And clean up the screen here. Okay, and let's go to today's new foreign currency transactions. We may be able to finish this one. We'll see. And just to kind of, explain what we're doing here. 4 and 5 are on accounting differences. This looks so small. 6 and 7, differences created by the foreign currencies. So we have foreign currency transactions and then the financial statement translations of foreign currencies. So chapter 4 and 5 are on accounting differences. 6 and 7 are on foreign currency differences. And as most of you know, foreign currencies and US currencies will have an exchange rate. So if you go to wherever, you go to Canada, you can exchange the US dollars for Canadian dollars. And then when you come back, you can exchange them back into US dollars and so on and so forth. And so there's an exchange rate for foreign currencies. And they change. They change over time. They can change by for any number of reasons. They change. Lots of stuff goes into it. But we have two types of exchanges, and that is the direct quotes, and these are dollar equivalents in the foreign currency. So let's look down here. $1 US. I can't remember. I got these from somewhere. I can't remember what year. But anyway, if we wanted to translate that into Australian dollars, we would say, okay, our $1 American is equal to about $1.45 in Australian dollars. So $1 could buy $1.45 of Australian dollars. So that's the direct one, going from directly from the US dollar to whatever the foreign currency is. The indirect is kind of going in the opposite direction, and that is how much is the foreign currency worth in US dollars? And this is the one we're going to be using the most, this indirect one. Because we're going to take it from let's put little stars by it before we do anything. See those stars, that makes us, well, it makes us happy, but also that's what we're going to be using. So if we have a company in Australia and this is the exchange rate, this is what we're going to exchange into US dollars when we make our US financial statements. Every dollar they have in Australian dollars for sales, for example, we're going to translate that into US dollars. And these are the reciprocal of each other in that you just take one divided by it and you get the other one. So let's prove out this one first. If I take one, oops, that's not a one. That's not a one either. So we have $1 of US money divided by 1.4453 732. It should come out to, or at least pretty close to that number. All right, let me see if that works. It should work. I don't know if they still do it. It used to be that they would have foreign currency traders that would yeah, that it comes out. So that this will come out to that. Okay, so coming down here, British pound. We want to figure out what that would be in US dollars. Now we know that our dollar gets us 0.85 of a pound. So we want to see what that would come out to. I'm going to copy this. Divided by 0.851. It's going to equal one something. I'm going to round this off to 0.1, something like that. So you can get that for any of these that you do. So this will be, and you will get these on the, you'll get one of these on the test. It's not gonna be worth a lot of points, like 5 points or something. Oh, I know, let's be smart about it. And I'll tell you how many decimal points we're bringing out to, 4 points or whatever it is. So this would be like, what would be in US? It would be, oops. I'll bring it out to 4. Yeah, 4 is good. 4 is good enough for what we're doing. If you're dealing in billions of dollars, you're going to keep all of them, but. And it can go vice versa. Here. Well, oh, this is what it would be. $1 would buy 0.96 francs. Renminbi, renminbi, yuan. Yeah, just call it yuan. All right, so that'll be 6.8549 rounding. And by the way, these exchange rates, they obviously fluctuate, from time to time, and also countries will try to sometimes manipulate those rates, because they can have an impact on their economy. One thing that governments like to do is to increase production and get things moving, is to devalue their inventory or their currency. Make the currency cheaper compared to world. And why? Because that makes their goods cheaper. That means people will come and buy their stuff. China does that. Many countries do that, and they will purposely try to devalue their own currency. You say, well, why would you do that? Why, that you can't buy as much. That's the point, is that they want people to buy from them. It makes their goods less expensive. Now, either you do have this other side of it, that the people in the country can't buy as much because the currency is decreasing in value. But so there's a balancing act there. But so a lot of times they'll try to evaluate. One of the problems they have with the in Europe with the euro, it's the same currency used in all these different countries. So if you have two countries that are using the euro, you have France and Germany using the euro. France may have very different things that they want to do than Germany, and so it becomes very difficult to manipulate the euro because it's used in more than one country. So you can't have those problems sometimes. And I know that's one of the things people have all. At first, they thought that was great that they had that in Europe, and then they started thinking about that maybe that isn't as efficient. But anyway, those are all things. But it's more efficient as far as trade. because you can buy and sell something, from France to Germany, and it's the exact same currency, and the borders are pretty much open, and that's it. But it can create a little bit more problem for individual countries. Anyway, so those are foreign currency. I don't know if it's still around. They used to have really heavy traders that would trade in currencies because you'd have it changing like from in the U.S. Let's say there's an exchange rate from well, whatever, the euro to Australian dollars. Okay, so if one of those changes, let's say that the Australian dollar changes, it's possible that there isn't that coordinating change between the Australian dollar and the euro, or at least back in the day, it used to take longer, and they would be trading around in circles trying to, and they do this with hundreds of millions of dollars, and they would trade around in circles and make money on those slight differences between, the rates of currency between other countries and the U.S. usually. And when you say why the U.S., because the U.S. had a big market in it. I don't know if they still do, but anyway, I don't even know if that kind of trading goes on anymore. Okay, watch. I'm going to click this, and it's going to go back to this. See, I'm learning. I'm not sure why it's doing that, but okay, let's go back to this. Okay, spot rates, today's rates. Forward rates are the rates that they use for purchasing or selling foreign currency at some time in the future. Oops. And these are, hey, these are mostly due to interest rates. So if the forward rate is higher, that means that they have interest rates that are lower than in the US. If it's at a discount, that means they have interest rates that are higher than in the US. So it's based on the interest rates. I'm going to stop early. I'm going to stop on this one. We'll come back to it, obviously, but let's stop this. Like, the reason I say I want to just go into this is going to be fun. So let's stop here, and we'll say come back at 6:54 about. Yeah, I think it'd just be better to take a break, and because this stuff we have to concentrate on. No, I said that wrong. Wait, this is 54. Well, let's say be back at 6:54. Okay. All right, let's go through, let's get rid of that. Yeah. Transaction exposure. To foreign exchange risk. So foreign exchange risk is when you are dealing in foreign currencies. If you're dealing in US dollars, you don't have it. And a lot of times, say a lot of times, I don't know if it's true anymore, but oftentimes in the past, it was US dollars were what many foreign contracts were in. And it was kind of seen as the US dollar was kind of seen as a currency that could be exchanged all over the world. And so that's why a lot of times you'd have these contracts, even though it could be between uh, two countries that between Mexico and Sweden, and the contracts would be in US dollars, even though neither one of them that's their their local currency. So it was very common to have that. It was almost like an international kind of currency that they had. They kind of thought the European euro was going to do that, but I don't think it caught on as much. But anyway, so oftentimes you'd have these contracts and they would be in US dollars. And especially if you're in a country that like China that's devaluing your money, you would rather have US dollars because US dollars aren't going to devalue rather than having it in the local currency. So the yuan is not maybe what you want to get paid in. Maybe you want to get paid in US dollars because that's going to hold its value more, especially if they're devaluing. I don't even know if they are devaluing it anymore. But anyway, so it was well, that might seem odd. If you're in a foreign country, you would definitely want to have the. Here we go back. I'm getting used to this. Oh, I think I know what it is. Maybe I don't. uh, there is a thing on Power Toys about hovering. I think it has to do with hovering. Anyway, so if it's in US dollars, there's no problem. So if you sell something to Canada and they're, whoever's buying them in Canada pays you with US dollars, it's fine. There's no risk. However, if it's in the foreign currency, then we do have the risk. And so the risk is that the currency will go up or down. And the risk might be plus or negative. We don't know, but there's a risk that it could change. Okay, let's see how this works. The Jacks company made a sale to an Australian buyer for $10,000 Australian dollars. The sale was made on 3/1/26. At the time, the exchange rate was 70 cents, 0.7 to 1 Australian dollar. Okay, so the US, do me a favor here. Let's put this so you know what this is. This is the US. Right underneath it or something if you print it out. So each Australian dollar is worth 70 cents US dollar. Okay, what's the journal entry going to be? We're going to use US dollars. Okay, the sale was made. I don't think that the so we haven't received the dollars. We'll receive the dollars later. I should break that in there. I don't think that's not clear. So this was sold on account. I should have put that in there. Okay, let's just take in general. If we make a sale on account, what journal entries are we going to use? Sold something on account. Forget about the dollars for right now. Anyone?
Accounts receivable.
Yep. So accounts receivable is going to be our asset going up. I'm going to capitalize these. It's going to be an asset going up. I'll fill in the numbers later. And what's going to go on the other side?
Is it going to be cash?
Not yet. It will be. Shortly, it will be, but not yet. Let's take a look at these are the kind of the 5 categories we have. Which one of these categories is closest to a sale?
Revenue.
Yeah, probably some kind of a revenue account. You can just leave it as sales. That's fine. I mean, there is no standard one. And the nice thing about revenues is they're virtually always debits. I said that wrong. Bad me. So revenues, or I'll put sales revenue. How about that? You can just be sales. You just leave it at sales is fine. And they'll go up with a credit. And these are virtually always going to be, whenever you have a revenue, it's virtually always going to be a credit. Despite the idiot thing I just said, that it's a debit. The sales are virtually always credits. 99.99%, unless you make some kind of an error and you're correcting an error, it's going to be a credit. Okay, now the question is, for how much are we going to do this for? Where we sold these for 10,000 Australian dollars. Each of those dollars were 70 cents US dollars. So if we're going to put this in US dollars, how much would it be?
7,000.
Yep. So we have 10,000. So the AU dollars. Let's try it again. We have 10,000 times 0.70 equals US dollars. So then we're going to record this journal entry for. We have accounts receivable 7,000. Now these are in US dollars that we're putting on our books for because we are a US company. But we're actually going to receive these in Australian dollars. So there is going to be some kind of a risk there, the risk of these changing value. Let me put parentheses around that. Okay. Okay, now coming down here, this is where we actually get the cash. So this cash is going to pay off this thing, right? We're saying that they actually owe us 10,000 Australian dollars, but in US terms, we're 77,000 when we made the sale. And now they're paying us. And the rate was this. 0.67 US dollars for every 1 Australian dollar. What is the value of the receipt in US dollars? I could probably put it down here too. Actually, I'm going to move it down one more. What is that worth? They just gave the 10,000 Australian dollars and the exchange rate is 67 cents. So what is that? So they gave us the 10,000 Australian dollars, just like contract called for.
So the actual money received would be 6,700 instead of the 7,000.
Correct. So this will be US dollar, oops, dollars. Okay, so this is the US, so this is what our cash is going to be. Oh, why does that look funny? What do I do up here? Okay, okay, so this is how much cash we're going to get. So cash is what kind of an account?
Asset.
Asset going up. Going up, so it's going up with a debit of 687. Now we have to take off this accounts receivable. And we got to take all of it off because they paid in full. And remember, this is really not in US dollars. This is actually, they owed us 10,000 Australian dollars. So we're going to have to change, we're going to do something to make these things balance. But this is going to be our, we have to take off the book. So this is an asset going down. And I'm going to move this down one. And I'll explain why this did that. Second here. Okay, so we got to take these out of the books for 7,000. So that is, let me back out a little bit. So that's that one, the green one. So we're taking this off the books. They paid it in full. Okay, now we got a problem. What is it?
It's not balanced.
Yeah, they don't balance. Let's think about this. Now this is going to be a transaction gain or loss. Which one is this going to be?
Loss.
Yeah, good. Yeah, we had it on the books for 7,000, but by the time we got paid, it was like, so we need to have a debit to balance this out. And by the way, this is a loss is similar to, like, say, an expense. It's money going out basically. So that's why it's going to be a debit here. So this will be we'll say transaction loss. And this is similar to an expense. You don't want to put it there as expense because it's actually a little bit different, but it's anyway, it's a loss, and it's due basically to the change in the value of what we got back. Any question on that? So again, there is a risk if it's in a foreign currency that it might not be exactly the same. Now the risk can go either way. It's possible that you have a gain, but it's also possible that you have a loss. Oh wait, I didn't put this in here. This was what, 6,700? Again, and the people buying this in, Australia, to them, it's just 10,000 Australian dollars. You know, uh, they paid exactly what they were supposed to pay. It wasn't, you know, they thought they were gonna be out 10,000. Oh, which financial statement would the foreign currency translation go on? Wait a minute, that's not a translation. Oh, I gotta hear the translation law. Maybe I'm wrong. I'm gonna say I'm wrong. I'm wrong. I'm gonna go with what I have on my notes here. Yeah, all right. So translation loss. I thought it was gonna be transaction. I'll tell you why, because these are actually transactions, but I guess it's the translation into US dollars is probably what they're just getting at. Okay. Oh, where would they go? They go on the income statement. This is just regular business stuff. Other comprehensive income is kind of a wacky one. Did we talk about this before? I can't remember. Um, Other comprehensive income is for long-term wacky stuff. They're usually very large things like pensions and stuff like that. And they will also have, when you translate foreign currencies into, under some of the methods that if you financial statements will go through this, but we'll talk about that next week maybe. Okay, income statement. So this is where the translation loss will go. I'll put it underneath there. So this would be a translation loss of $300. And it would come off for income. Anything different on this one? Go ahead and see if you can do this one. I'll give you a minute. I'll kind of, instead of talking over it, I'll let you guys kind of work through it too. Similar to what is that we just had. This again is they're making a sale. So as we're selling to somebody else. And we're gonna have 50,000 yuan. And this is the exchange rate. What the exchange rate for the yuan is now. It's a very important, China has a tremendous amount of power. It's about point five. Actually, the 0.15 isn't far off. About 0.144 something. So apparently, yeah, and I think that I actually had these in here at the rate, so it probably hasn't changed that much in the last 3-4 years. Okay. These are virtually all as credits. Whenever you have a sale, it's gonna be a credit. So, at least to the US, they're able, because that might also have to do with US being a little bit out of control now. A lot of things go into these. So 50,000 times that. It's say $500. Okay. And again, while our books are in US dollars, they actually don't owe us US dollars. They owe us 50,000 yuan. So that's going to be, even though it's in US dollars, the translation when we actually make the deal, it's not going to be in US dollars that are actually paying us. Okay. Oh, okay. So the yuan went up in value compared to US dollars. They're 9,000. Yep. Okay, so when they actually paid it, this is how much cash we got? Oops. Do we have a gain or loss on this?
Game.
Gain.
Yep. Oops. So balance receivable on 7,500. And yeah, we had a $1,500 gain on translation. I should say translation gain, I think is the terminology. And so that we go on the income statement. So it'll be plus 1,500. and add it to your income. And part of the reason why and so the income statement is stuff that really happened basically. So this actually really happened, that we actually had a gain here, and then on the previous one we had a loss. These are actually things that actually happen. The transaction is completely completed, and that is, what happened with the foreign exchange risk. Okay, this next one is going to be a little bit different. Starts out exactly the same. So let's do the easy part. Okay, so we have accounts receivable. By the way, you don't have to put this in asset going up or whatever. You don't need to put that in. I'm just doing it so you know how I can put a debit or credit. Sales revenues. Sales and revenues are always credits, which is very comforting in these trying times. Okay, so you should know that. Well, it's 15,000. I think that's it. Okay, so this was made on December 1st. We have not received anything as of the end of the year, and we won't receive it until the 15th of January. So this is at year end. Oops. I know. Let's get rid of the capitals for now. So this is at year end. We have this, we're looking over our stuff, and we have this accounts receivable on our books for 15,000. The exchange rate is now, excuse me, 77 cents. So what is this sale worth on December 31st? I asked a question I don't know the answer to. Oh, give me one second. That can't possibly be right. Try one more time. Okay. So what is this thing worth now? This accounts receivable.
15,400.
Yep. Oh, I forgot to put my caps back on. Probably less annoying anyways. Okay, so this is 15,400. Okay, so now notice we have not received the cash yet, though. They haven't sent us the 20,000 Australian dollars. So this is not cash, but this is how it changed. Okay, well, what are we going to do with that? So they haven't sent us anything. There's no cash.
Would it be accounts receivable 15,400, transaction gain 400, sales revenue 15,000?
Very close. Very close. We've already recorded we're only going to record the difference. But what you said is actually what it's going to end up being. Yeah. So we already have accounts receivable in the books for 15,000. We need to get it up to 15,400. So how much additional are we going to add to this?
400.
Yep. So what I'm going to do is come down here and teach you guys how to be lazy like me. Now we only have to add 400 to this, and now there'll be a total of 15,400 in the account. Okay, now we're unbalanced. What account are we going to use? Actually, I'll give you a choice. A translation gain or a translation loss? Is more money coming in or less?
Gain.
Gain. Hey, go back to my capitals. So we're going to record a gain of 400 at year end. We're going to say, okay, so this is actually how much this account increased in value at year end. And we will book that on our net income. Okay, let's go down to the last one. Let me mess it up just like I do every time. I'm gonna put this down here, our calculations. So now the exchange rate is up to 80 cents for one Australian dollar. So the Australian dollars haven't changed. So now they send us these 20,000 Australian dollars, and at this point, those are worth was that 16,000? Yeah. Let's try that again. Okay, so this is now how much we're going to get. So that what they sent us, the 20,000 Australian dollars, is now worth $16,000 US cash. So this is going to be our cash. Okay, now for the tricky part. How much of accounts receivable do we have to take off the books?
15,400.
Yep. So this is going to be an asset going down. They no longer owe us. Oops. Let me do something here. Looks like a looks like enjoy or something. Okay, so we have to take that off the book. So this would be green. $15,400. Now what? You don't balance.
It'll be translation gain 600.
Yep. So, so we have a translation gain of 600, and notice we got these in the correct period. Overall, it went up by 1,000 US dollars, but 400 of that was in 2026, and 600 of that was in 2027. So we got it in the right periods. When when the gain actually happened. But anyway, yeah. So that is the journal entry for that. Okay, another one. Do your best with this one. See if you can figure this one out. By the way, feel free to abbreviate AC, for excuse me, AR, accounts receivable. That's common. You don't have to write it all out. And I mean, on a test and all that, also same thing. Okay, what should be the entry for? Oops, wrong one. What should be the entry for the 31st?
So it'll be accounts receivable 2,000 and transaction loss 2,000.
Yep, good. Now the we have to reduce the accounts receivable, right? This is accounts, yeah. Oops. So accounts receivable is going to go down by 2,000. And yes, this will be a translation loss. And again, losses are kind of like expenses. They're always debits. So losses are debits, gains are credits. You know, revenues and expenses, think about revenues, think about gains. You know, revenues are money coming in. Gains are money coming in. Expenses is money going out. Losses are money going out. So they kind of apply to these two. And yeah, so revenues always go up with plus, so gains always go up with credits. And losses always go up with debit. So this will be a debit. And I'm going to highlight this. Was that green before? It was. We'll keep it green. So we've taken out 2,000 out of that account. Because at year end, it's not worth that much. The account is only worth, what, 15,000? Okay, we come down here. And the value has jumped up to 18,000. So what's the journal entry going to be?
Translation gain for 3,000
Yep,
and accounts receivable 15,000.
yep. Oop. You generally don't put dollar amounts in there. I know you didn't, I did. uh, all these are in dollars, they're US dollars. You generally don't put the dollar amounts in the journal entries. I guess there's nothing wrong with it if you do. You don't usually do. So yeah, so there'll be a translation gain. So here's what would happen on the 2026, we'd show this translation loss on the financial statements. And then we showed this translation gain on the financial statements in 2027 at year end. We'd show that translation gain on it, and that's really what happened. We lost 2,000 going into the end of 2026, but we recovered 3,000 going into 2027. So it does put the correct gains and losses in the correct periods. How many more of these do we have? Oh, two more. Hey, let's get this done. Okay. These are imports. So when we buy something. Okay, so notice what happened. We have this contract, but it's not in US dollars. It's in Indian rupees. So, so here's what's going to happen when we definitely frozen picture me. Here's what's gonna happen, we're gonna have to come up with, idiot, we just lost how many we had. 500,000 rupees. You know, when we pay this off, we're going to go buy 500,000 rupees and pay it to them because they don't want the US dollar. Yeah, they want rupees. So we're going to, have to buy those rupees and then pay them with, for their whatever this is we're buying. And I realize I'm going to go through this again. Oh, I know what it's doing. I know why it's doing that. It was me all along. Okay, let's see. Okay. So the purchase of equipment. Okay, so we bought some equipment. What kind of an account is equipment? Hold okay.
Asset,
Asset.
Yeah, equipment's an asset, and if we're buying it, is it going up or down? We have more equipment or less?
more.
More. So it's an asset, and it's going up. All right, and let's see. I don't think we paid for them yet. We'll pay for them in a month. Okay, so we owe them this much. How much do we owe them? That's a good question. I'm missing a zero. No, I'm not. Wait. I got my comma wrong. But okay, times. Eleven thousand. I better use a calculator. Yep, 11,000. Okay, so this is we got $11,000 worth of equipment. And we haven't paid for it yet, though. What kind of account do we use if we haven't paid for something?
Accounts payable,
Yep. Accounts payable, and that is a liability, and it's going up. I'm going to shorten liability because I know it'll mess up my spacing. So as of this point, we owe them 11,000. Oh, was it worth any US dollars? This is worth 11,000. Okay, so weird spacing on this thing. So this is so we go to pay this off on 7/1. So what we have to do is we have to go buy 500,000 Indian rupees. So we have to buy that, and these are at 25.025. What would that be? Yeah, 12,500. Okay. So we gotta go buy take 5,000, 12,500 and buy 500,000 rupees. So is our cash gonna go up or down?
Down.
Down. So our cash is going down. I'm gonna move it down one here. Cash. It's an asset and it's going down by 12,500. So we buy these rupees. What else do we need to do? So the equipment's already on the books. Do we still owe them anything?
Yeah.
Well, actually, I mean, okay, let's assume we bought the rupees and gave it to them. So we don't owe them this anymore. So we'll take this off the books at exactly what we put it on at. Oops. Now what? No, what's this?
Would it be translation loss?
Mexico, so
Yep. Exactly. Ooh, hold on. Let me do something here. Yeah, it'd be a translation loss. $1,500. Oops, no, not that. Yeah, so it'd be a translation loss of 1,500. Because the cost of the rupees went up, so we have to cover that cost. Oh, shit.
Rupee doopy doo.
I'm sorry.
Oh, sorry.
Oh no, no, I'm sorry. I know I told you guys this. I got my jaw is apparently got a bone infection in it. Which, by the way, if you ever have the chance to not have a bone infection, do it. So I'm just gonna turn this thing off. But anyway, I've been to the hospital. I've been on emergency room, and it looks like they're gonna do intravenous, and they might have to do surgery on it. But anyway, I get like you go to all these different hospitals, so you literally get like I don't know, like 10 to 15 text messages a day. And they have how was your appointment on blah blah blah? Don't forget you have an appointment on blah blah blah. Blah blah. We sent in your medication for blah blah blah. You're just like, oh, come on, man. And you get email and you get like tons of letters and all that. Okay, yeah. So this is what we do for that one. And again, it's the same thing as the sales, except in this case we're buying it. And again, if we were paying in US dollars, it wouldn't be a problem, but if we're paying in something else, then there could be. Okay, another one. Oh, this one has a year end in between. Yay, that's even more fun. Okay, so let's take a look at this. So we purchased, equipment. Yay. It's an asset going up. Um, we gotta figure out how much is it worth. It is 1 million. that 27,000? I think it is. And it's not liking it. Okay. So we got 27,000 worth of equipment. And by the way, the equipment is just whatever we paid for it at the time. This is the same. We don't change anything on that. You know, at the time we bought it, that's what the equipment was worth, apparently. So the rest of this, you know, pluses and minuses, they have nothing to do with the equipment. Oh, I didn't put that one in. Okay, and we also owe them. It's a liability going up. We got more equipment, but we also owe them more money. And I'll make that green just because. Because them's the rules. No, I guess there's no rules on the coloring of it, but let's just say there are. Hey, did I ever tell you guys about like studying for the CPA exam about using color and all that? I'll give you guys a handout. That's class on that. But believe it or not, seeing color is much more difficult for your brain. So you say, okay, well, it doesn't seem like it's more difficult for the brain, but it actually is. And that's why you'll remember things more if they're colored than if they're just black and white. Because your brain has to work harder and your brain says, hey, I'm working harder, this must be important, and it remembers it. And we're going to use that to study for the CPA exam. Okay. On 12/31, the Indian rupees had an exchange rate of 0.021. Now, we did not pay them on that date. We owe them on that date. Strange. Okay. Oops, that's wrong. What are we gonna do with that one? By the way, that's a huge that's a huge shift in whatever was the 13th. So as whatever it is. 20 no 18 days. So what are we gonna do with that?
Would it be accounts payable debit for 6,000 and then translation gain 6,000?
That's exactly it. Very good. So accounts payable, this is actually a liability going down. We don't owe them as much. Well, we owe them the same amount of rupees, but in US dollars, we owe them less, 6,000 less. And yes, that is a translation gain. Oops. Okay, I am going to, let's see the trailer. I'm gonna make that in red. I can hear my dogs upstairs running around. My son burnt a pizza last night, so the whole house was filled with smoke. The dog barked to get me to, Okay. And today the dog was scratching at the door, and they go up there, and sure enough, another thing burning. I know you're thinking, oh, he burned another pizza. No, he burned cookies this time. So good thing I have a dog that tells on people. All right, more. He was burning cookies. All right. Let's see. The Indian rupees were paid by Jen's company. At the time, the Indian rupees paid exchange rate was 20 cents. Okay, let's take a look at that. So this would be oh, that's even better news. What would this journal entry? Well, that would be the cash. So we take 20,000 cash, we go out by 1,000,000 rupees because that's what we have to pay these people in. Oh, I did that wrong. Did I do that wrong on the other one too? No, I didn't. I did it right in the other one. See, like 15 minutes ago, I was much smarter than I am now. Okay, so this is cash. It's an asset going down. We're gonna pay these people $20,000 in US, but more accurately, we're gonna pay them 1,000,000 rupees. Okay, now what?
Would it be accounts payable 21,000
Yep.
and then translation gain 1,000?
Yep. That's it. So we no longer owe them anything. So we're taking the entire liability off the books. And yes, we got out even cheaper. Well, we got out cheaper if we're not dealing in rupees. And a lot of times, you'll see, a lot of times they'll have companies will leave it in the local currency. Because if they keep it, so it really depends on how involved they are in the country. Okay, so this would be, yeah, so that would be it. And I think we're done with it. What do I have else here? I'm going to talk a little bit about derivatives. So derivatives, what are they? The question when you're looking at this becomes, can we, okay, well, I want to deal in this, with a foreign country. They don't want US dollars, they want their foreign currency. That's what they pay their employees with and all that kind of stuff. So they want their currency, in their currencies. So you say, well, okay, but I don't like the risk. I like knowing what I'm going to be paying. I don't want to, I want to know this would be 20,000, not 25,000 or whatever. So yeah, you can actually do hedging, and there are different ways of doing it, but you can actually buy. It could either be there's a few different ways you can do it, but the ones I'm going to show you on here are derivatives. And derivatives get their name because their value is derived from something else. Whatever the financial instrument is, whatever the I'm drawing a blank. Well, whatever the investment is, I guess is the way to say it. It's derived from something else. A coupon example. For example, let's say you give a coupon to buy a new phone for $100. Well, how much is that coupon worth? If the new phone really costs 137, then the derived value of the coupon is $37. The coupon you saved, $37 by using the coupon. So it's derived from whatever the value of the phone is. So the value of the coupon is derived. If the new phone only costs $88, then the coupon is worth nothing. Why would you use a coupon? Why would you, why would you use a coupon to buy a phone for $100 when you can buy it for 88? So again, it could be that the derived value is zero. A coupon to buy a phone for $100 only costs 88 isn't worth anything. So derivatives means that it's derived from something else. And you can have future contracts, and future contracts are contracts that must be filled. And you can buy these contracts, putting them forward, what you can buy things at or sell them at, depending on whether you're buying or selling the whatever the certificate or the currency is in. These contracts are usually bought back rather than fulfilled. Yeah, and by the way, if I told you this, I used to work on the Chicago Board of Options Exchange. Maybe like 6 blocks from us, maybe a little more. But they deal in. I don't know if they still are. They used to have be the biggest futures market in the world, and you could actually buy futures in financial instruments there. The Mercantile Exchange also is very big in financial stuff. Probably bigger. The Mercantile Exchange, which is probably 10, 11 blocks away, is from downtown, from our building downtown Chicago. And they used to be the largest in the world for financial instruments. I don't know if that's true anymore. Probably not. But so future contracts are contracts that must be fulfilled. And usually the way those work out though is people really don't want to fulfill them. They'll just use them as the hedge, and the value of those will be whatever they are at the end, and they'll just buy back the contract. So, and they could be in anything, 10 million bushels of corn. Well, you really don't want to buy 10 million bushels of corn. You already have an order in for 10, so what you're going to do is hedge it and then buy back the contract if you need to. Okay. Options are similar to futures, but options are you have the option of doing it. I don't know why this is over there. But so option contracts means you have the option of buying something. And again, it could just be that you don't exercise the option if you don't want to. So you pay your money for it, and if you don't want to exercise it, you don't exercise it. But if the market goes against you, you can exercise it. Okay, now there is a problem here. And that is sometimes people will, instead of using these derivatives for hedging on contracts, it could just be a plain old investment. You can buy future contracts. Anyone, these are just securities. There are securities that are derivatives. They're derived from something else, but you can you can set up an account and buy and sell these derivatives. So the question is, at what point are they a business necessity, and at what point are they someone just kind of playing the market, trying to make money? Because those are two different things. If they're actually, if they actually are hedging, it's just part of normal operations. But if they're not hedging, then it's an investment, right? So, this might be for inventory. If it is really hedging, that you're actually, those are just costs of doing business with a foreign supplier or a foreign customer, and that there are risks involved that you're trying to avoid, and as long as they match up, there's nothing wrong. So the first one is that they're going to be for the value of whatever the contract is. The derivative has to be effective in offsetting that. So it has to be effective. It has to be matched up with how much you're at risk for. It can't be more. because it could be less, but it certainly can't be more than that. And that you probably document that as a hedge for a specific transaction. You can't just say, okay, we do a lot of business in, we do a lot of business in India, so any rupee contract is going to be a hedge. No, no, no. It has to be per transaction, a specific transaction. So it has to be for the amount. I would think it would be if you do it for less, you could do it for less and still be a valid hedge. But certainly you couldn't do it for more. And the derivative has to be effective in doing it. In other words, it has to be in whatever year, if it's a rupee contract, then it needs to be 4 rupees and it has to be documented. They all three have to be met, or else it's merely an investment. It's somebody playing the market and it is not part of the regular business. It'll be accounted for separately. Hey, we're done with that one. I didn't think we would be. Okay, so let's, any questions on that? I'll tell you something funny. When, I told you I worked for the Chicago Board of Options Exchange. My undergrad's in finance, and I wanted to go into trading. And it's very cliquey. It was very cliquey that you couldn't get in. You had to go to certain schools, and if you did, for different firms, you literally, if you want to go, work for a certain firm, you would see who they recruit from. Which I didn't have that knowledge when I was 18. You go into and so, for instance, a certain firm trading for ABC, they pull everybody from Northwestern. And trading for XYZ, they pull everyone from Michigan State. It's just that they were always kind of cliquey that way. And if you didn't go to whatever school they recruit from, you wouldn't get in. But anyway, so I got my CPA. So when I get my master's degree, it wasn't in finance, it was in accounting, a CPA, and I had sent out to some different places my resume, but also one resume I was going to do accounting, but I was going to say okay wherever. Anyway, I got I got called into G-Bar, which was, I don't know if they're still around, but anyway, G-Bar, you did the Chicago Board of Options Exchange, trading in stock options. And I started working as I actually did what they call gamma adjustments for the, but it was kind of funny, when I went into I went into accounting because I couldn't get a job. And when I got the accounting, then that opened up the door. And about 20% of the traders they had were CPAs, just because we're good at numbers. They need to be good at numbers quick, and all that kind of stuff. So kind of a weird thing, you go into something else because you can't get into this way, and then it opens the door up. But it was very odd. Any questions? Okay. So let's see, we can turn in the one from today. And let's go back to this. Okay, so we finished this one. So you can turn that in. And this one. We got 2 things in today. So you can turn that in also. Those things will be turned in. And I will be sending out, by tomorrow, I'll send out the chapter 4 and 5 exam. And it'll be stuff similar. I'm not going to go, it's not going to be the last big crazy problem we did. It's not going to be that involved. The one I'm drawing a blank here. I'll just be quiet. But anyway, I'll send out the chapter 4 and 5 exam shortly. Any questions? Okay, have a good weekend. I will see you. Wait, I think do we have a class next week? I think we do. So some of you I'll see in class and some of you I'll see in Zoom land again. Have a good evening.
All right, good night.
Thank
Good night.
you.
Thanks. Good night.